Welcome back to another episode of the Vet Worthwhile podcast. I am James Yost, partner and wealth advisor at SignatureFD, and I'm joined as always by my co-host Travis York, owner of 3-1 Advisors. Travis, how are you?
I'm doing great today, James. How about yourself?
I'm doing well. We are back with another episode of the Vet Worthwhile podcast. As always, you got James Yost, you got Travis York. Travis, we got a guest on today. Who do we have on? Who are we talking to? What do we got on the docket for today?
I'm excited to introduce our guest today. We got a chance to connect with Rich Lester. Rich, it's been quite a few years since you and I first connected way back. I remember it was at Western out in that big food court back in probably the very early days of VPP. And at that point in time, I was wearing a whole lot different hat and probably a whole lot more naive to what was going on than I am today. Naive's maybe the wrong word. I didn't quite understand, didn't have quite as deep an understanding, but really excited here, Rich, because I think, you've had a front seat to, the last kind of 10 years of just, massive shifts and movements and changes inside of the veterinary space. And so, an opportunity to hear, kind of firsthand what you've seen is going to be a lot of fun.
Looking forward to talking to you, the two of you, about it. And it has been a while, and looking forward to the conversation.
Yeah, I guess so. For those of you that don't know, Rich, you were founder or co-founder of VPP, which was a group that was based out of outside of Philadelphia. You acquired what, kind of north of 100 hospitals in that role, ultimately the CEO of that organization?
Yep. I was the founder and CEO under my leadership for about 9-10 years. We got to north of 70 hospitals, 150 million of revenue. Today, I stepped down in 2020 to lead a less stressful life. The new CEO, a friend of mine, John McDonough, has grown the business. It's now probably 120, 130 hospitals and growing.
Very exciting. And you guys had a kind of a unique model when you were acquiring hospitals, when everybody else was really out, kind of leaving, I hate to say leaving the associates behind. You guys had some components to your model that allowed associates to have some direct participation, even if they didn't come to the table with ownership. You have always, that VPP has always been deeply invested in, a pretty significant commitment from their partners. And I think it's been a pretty neat model to see roll out and play out, and probably truthfully seeing some other people that are maybe later adopters in what you were working on.
Yeah, I always like to say that imitation is the best form of flattery. And back in 2011, the vision was a joint venture model where a local doctor and or a local associate plus a local, the owner, stay owners in that individual clinic. So you have someone on site who is aligned with your incentives. And back in 2011, 12, 13, most people looked at me like I was crazy. Like, why would you want the doctor to own a piece and blah, blah, blah. Now today, and especially from my new seat at Ackerman, I see most major consolidators using something like this model. There are a few still buying 100%, but most have come to realize that the direct provider of care, the people who generate the revenue, aligning incentives with them is really important. And especially with the veterinary shortage, it becomes more important than ever. So there has been some, I call it validation, by watching lots of other corporate groups follow the model in some way, shape, or form.
Yeah, well, I guess, so you kind of brought it up. You have, exited the VPP world, and you're now part of Ackerman. And so you're using 10 years of front seat experience to help guide veterinarians through that sale process, structuring a deal that works for them, and you've also been at the front. You maybe got out before we started living in absolute craziness, but you've had a front seat to all the craziness. So I guess maybe I just start in your new role as kind of, leading an organization that helps veterinarians create their exits. maybe let's just start with the foundation of, over the last 10 years, what did you see? What were the drivers in why the consolidators handled things the way they did? What drove veterinarians to exit hospitals? And then how do we see this rapid rise and this kind of rapid, maybe I don't want to say retreat, but I mean, truth be told, multiples and valuations just are not quite as aggressive as they were 18 months ago. And so, your insight into how we got all of those pieces to come together and what drove it would be, I think, incredibly great for our listeners.
Yeah. So a few pieces. So first, I'll start with my own sort of role in this. So I was on what I call the buy side, or I was buying clinics for almost 10 years. And then after taking some time off in 20 and early 21, I joined with Gary Ackerman in Ackerman Group. And at Ackerman Group, we always help doctors figure out their exit plan. And Gary and my joke is that I'm sort of part of Gary's exit plan. Gary is 66 and starting to slow down, and I'm 56. And so I'm helping lead that organization. So he has an exit plan, just like we have exit plans for all the doctors we work with. Then on what we've seen in the market, I'd say that there was a unique, let's go to the bubble that happened in 2021. And there was a really unique convergence of events in 2021 that led to extraordinary multiples. And the convergence of events were sort of a couple of things. One, you had interest rates at near zero because of what was going on with COVID, and the Fed was trying to stimulate the economy. And so interest rates were basically zero. Volume or visit growth at veterinary clinics ballooned in 2021. There were a lot of COVID adoptions. People were working at home. Pets got sick. Veterinary invoice volume, which normally grows 0.5% to 1.5% each year, grew probably 7 or 8% in 2021. There was just this massive growth trajectory in invoices and in volume, and therefore revenue. And so investors sort of started thinking, maybe there's a fundamental change in the market and we can pay more for individual assets because invoice growth is tremendous. Interest rates are virtually zero. So we can just start paying up. And we saw valuations in, I call it the 12 to 18 times EBITDA range, which is just an extraordinary level for an individual veterinary practice. I mean, a practice with $500,000 of profit of EBITDA was trading at 14, 15, 16 times, and practices with $1 million more of EBITDA were trading at 17, 18 times EBITDA. And it was extraordinary. But then 2022 showed up and the Fed started to raise interest rates. And as everyone knows, interest rates have gone from virtually zero to now 5.25%. And by the way, that invoice growth was a temporary thing. In 2022, invoices were on average down 3%. This year in 23, they're probably down about 1.5%. So the growth was, there was a bubble on the growth side, and things are going to regress back to that mean, I think, in 2024, where invoice growth will go back to that steady sort of 0.5% to 1.5% invoice growth.
It's almost like COVID kind of accelerated adoptions. Like if it had been on the radar, people ran out and adopted, and then there was a kind of a lull, and we'll get back to kind of where the world operates.
Yeah, well, there's this bubble, then it falls off. And by the way, when you have 8% invoice growth, the comparison set for the next year is unbelievably hard to grow off of that. So it's just, not so easy to grow off of those kind of crazy numbers. So it takes time to settle back to the norm. And everything, I always say, things regress back to norms or means. And, you have a decade worth of data in the 2010s that say veterinary invoices grow 0.5% to 1.5% a year, and revenue grows 4 to 6% a year. And we will get back to that, I think, in 2024.
Well, and I think the other thing that's so interesting on it to me is, obviously there was tons of capital out there, Rich, which you know better than probably any of us. It was incredibly cheap.
Yep.
And so you saw, deals that were structured with more cash.
Yep.
You saw groups that saw 6 months of data and extrapolated that out into their models over the next 36 months.
Yep.
And we almost, not only were we seeing, like, yes, in our world, it was like 22 times EBITDA, but, they really saw a clear path to bring that back down to a more manageable, multiple of EBITDA, really based upon kind of probably some bad data.
Well, it was based on a continuation. If you assume that invoices are going to keep growing 4, 5, 6% and revenue grows, double digits for the next 3 years, it's easy to have the clinics, your projections show that the growth will buy down the multiple, i.e. EBITDA will grow at an extraordinary rate. That wasn't the reality, and that has led to sort of the market retrenching and some changes in both deal structure and in sort of aggressive buying. And I think
let's get into that a little bit, because obviously the hospital owner community is relatively small. And there was such a boom in sales, just the volume. We talked about the high multiples relative to history. And then you just have, word of mouth community where their friend or their buddy from vet school got 22 times or 18 times or whatever. And now they're going out looking at the market, and it's, somewhere between 10 and 14 times. I mean, how are you advising them? And then, like, the $1 million question, of course, is when are we going to get back to those same valuations, if ever? Like, how do you answer that question? Because I'm sure you get it all the time.
Yeah. So a couple of pieces. So the question of, will we ever see this bubble again? And my answer is it's possible, because anything's possible. I think the events that led to this particular bubble are unlikely to happen again, because the idea that you just typically don't have extraordinary growth with a zero cost of capital, with interest rates at zero. Usually when you have extraordinary growth, the Federal Reserve is raising interest rates to try to smooth and slow the economy. And if there is another COVID-like event in 3 or 5 years, and there is, this need to drive the economy and the Fed lowers rates to zero, I think they will be much more aware of raising rates more quickly to head off inflation, which they were slow to do this time around. So I don't think this type of event will lead to a bubble, that what we saw in 21. There is, at least in my sort of putting my, seer hat or vision hat of what's going to happen in the future on, the way I see multiples getting extraordinarily high again, you need a handful of events to happen. And those are, one, you need a couple of veterinary companies to go public and become publicly traded, which I think is likely to happen in probably 2025 and 26. When the stock market gets more receptive to IPOs, there are a handful of veterinary service providers that are large enough to become public companies. So we think that will inevitably happen. And then when you have some public companies, if then you have another stock market bubble, whatever causes that bubble, I don't know. But, we had a stock market bubble in 99 and 2000. We had a bubble in 2006 and 7 that burst. And then we had another stock market bubble in 2021. So over the last 20 some odd years, we've had 3 stock market sort of bubbles. And so the next time there's a bubble, if there are publicly traded veterinary service companies, their valuations will be really high because of that bubble. And that will lead them to then overpay or pay higher prices for individual clinics. And so does that happen again in 2028, 2030, 2032? Who knows? But I think it is very likely that you will have publicly traded companies and in the vet services space. And then I do think that it is inevitable that there will be another bubble. And those are the conditions that I see eventually leading to a potential bubble in the veterinary world.
Let's drill down a little bit there, because
Yeah.
I don't think most hospital owners can like really understand the relationship between their hospital and the stock market. Yep. And obviously there's a lot of intermediaries there that tie those together, and there's spreads that are obviously there. And I think the easiest way for them to understand is understanding the platform recap space and what happens there. So that's kind of the thing that connects those two.
So let me
drill into that a little bit, and then maybe give us an update on what's going on in the recap market as well.
Yep. So the way we think about valuation of individual clinics is there's a direct correlation between Joe's veterinary clinic in small town USA and the valuation that either a private equity firm places on a consolidator, or when companies are public, what the public market places on a consolidator. And that spread is usually around 8 turns. So by that, I mean, if the consolidator is selling at 20 times EBITDA, the individual clinic, like the peak value for the individual clinic, is probably around 12 or 13 times EBITDA. But if we have a public company and they're selling at 25 times EBITDA, then the individual clinic, 25 less 8 would be, 17 or 18 times EBITDA. And so I think the way to think about it is there's how the consolidator is valued places a limit or a max number on what they'll pay for an individual clinic. And so there is a direct correlation between individual clinic values and sort of the consolidator or platform valuations. Is that clearer?
Yeah, I think that's perfect.
Okay. So and I think it's important to know, like, waiting and saying, hey, I'm going to time my sale for the next bubble is something that's really hard to do. If you're 40 years old and you own a nice practice and you can wait a long time, you might be able to do that. If you're 55 or 60 years old and you have a definitive retirement timeline, waiting for that bubble could be a fool's errand, because you need to think about what you want from your life, and maximizing every last dollar may not be as important. The other piece on the market that I should say is that today's valuations, which I would put at sort of 8 to 12 times EBITDA in today's market, you might see a 13, are very similar to what individual clinics were getting pre-COVID in 2018, 2019, and the run up to COVID. And those values are, on historical terms in the industry, are still really robust. I mean, back when I started VPP in 2011, if we paid 5.5 times for a big practice, that was a lot. 6 was the top of the market. And multiples didn't get beyond sort of 6 times EBITDA probably till 2016, 2017. And then they started to climb a bit there. And so for decades, from the founding of VCA in like the late 80s through about 2015, no one paid more than 5 or 6 times for an individual clinic. And so it's only as more private equity firms have found the industry have we seen multiples start to rise. And today's pricing is, on historical terms, is still pretty darn good. It's just not extraordinary like it was in 2021.
So how are you kind of guiding clients right now, Rich, in light of all these factors, right?
Yep.
My classmate sold at 20. 10 years ago, I thought my hospital was worth 5 times EBITDA. Like, man, I'd love that 20. I'm here at 12. What's the right mindset for a 45-year-old doctor? I mean, is there a risk that if you don't pull the trigger now, we could see 5 and 6 doctor hospitals selling at 8 times EBITDA in 3 years?
I think there's a very low risk of that. So the way I'll go back to the original question of how do we guide our doctors? And it's a very individualistic sort of discussion. The things that go into the discussion are, one, the conversation we always have is, when do you want the optionality to retire? Not when do you want to retire, when do you want that option to retire or slow down? And if it's in less than 3.5 years, we always tell people you should have started your process already, because it takes 6 months to sell the practice. And most buyers, if you're a producing owner, are going to expect at least 3 years from you. And so the conversations with individual owners are about what are their goals. And if they're 62, it's a different conversation than if they're 50. When we're talking to a 50-year-old, the question is always, are you stressed out and do you hate running the business and do you want to just go back to being a doctor? Or are you trying to maximize value and you're fine being a practice owner and running the business? And if they're fine being a practice owner and just running the business, and it's not creating problems with work-life balance and other things, we tell people it's not a bad idea to wait a little bit and see what happens when interest rates go down. But if you're 50 years old and like you dread going to work every day because you hate dealing with human resources and recruiting issues, then we tell people like it's still a reasonably good time to sell. Like if you've got a good practice, valuations they're not all-time highs, but they're at a reasonable value. And so the advice is around really what the individual's goals are and also on their sort of personal situation.
There's also like, this is, I think, is lost in the shuffle because we're all, market guys, we understand transactions, but it's, the multiple is just one factor, a factor of how how you can get compensated for EBITDA. You can also grow your EBITDA at the same time. So in the event that market multiples are stagnant or have come down, I mean, the practice owners can focus on that's something they can control. You can focus on what you can control, which is increasing production, getting people ramped up. I mean, figuring out ways to bring costs down and become more efficient. So there's always something that they could be doing and we had our CI, our chief investment officer, on a couple of months ago talking about this. I mean, even though multiples have come down, the economy has stayed relatively healthy. And so people are having a higher EBITDA base and a lower multiple. You can still get similar value on the practice if you do those things correctly.
Yeah. And I think your point is extremely well taken because, I have one prospective client who I've been talking to in the last couple of weeks where they lament a little bit that they didn't sell in 2021. But now 18 months later, their EBITDA is 60-70% higher than it was in 2021. So the business as a whole, even though the multiple is down, is worth more money. And so they've just had tremendous success over the last 18 months. And so, and I tell people, like, if you're growing, if you've got $750,000 of EBITDA, that's money that's going into your pocket each year. So each year that you continue to own, you're getting that profit. And by the way, if in 3 years multiples are down 1 or 2 turns, and instead of 13, you might get 11, well, you really didn't lose anything by owning for those couple of years because you collected the profits already, and hopefully you grew the profits some. Yeah. So if you're running a sound business and you're happy running it, you've got a lot of options. If you're running a sound business and you don't enjoy running it, it's sort of a different question. And then if you throw retirement into it, that adds another piece to the puzzle.
So let's get into current conditions. Yes. So what are you seeing out there? And just thinking about the hospital size, so like a large versus a small hospital, are there options for them? Quality of the sellers, what's the most important thing? And then Travis talked a little bit earlier about how deal structure has evolved over time. What's the current standard today?
All right. So I'm going to give an array of thoughts on how the market's changed and evolved. So the first thing is that we talk about how the buyer community evolves. And so the best example of that is in 2021, there were at least 5 corporate groups that bought over 50 clinics in 1 year. And in 2023, there are probably only going to be 3 groups that buy over 50 clinics. And by the way, there is zero overlap in the names of the consolidators that are buying today over 50 clinics versus 2021. So there were 5 names in 2021 that bought over 50 clinics. None of them today are buying that aggressively. And there are sort of 3 that are buying aggressively that weren't buying aggressively in 21. And so my point is, it's a fluid market, and who is buying a lot and who is aggressive changes over time and changes relatively rapidly. 21 versus 23 is not that much time. And we've seen a marked shift. So that's one point. The second point is that the amount of cash that's being offered up front is down significantly. And that's just the nature of interest rates. I mean, while we talk about the Federal Reserve's rate, which has gone from 0 to 5.5% or 5.25%, the borrower, being the consolidator, they don't borrow at 0%. They were borrowing at probably 5% back in 2021. Now they're borrowing at 10, 11%. And so their cost of capital is really high. So they're doing all sorts of things with deal structure to delay putting out cash. And so if you get 60 to 65% of your purchase price today in cash up front, you're doing pretty well. And so the structural elements that come besides cash are there seller, are you taking back a note that says, hey, we're going to pay you more purchase price over time? 2, the VPP model of doing a joint venture where you retain 20 or 30% ownership in your hospital. That's becoming more common. The use of what we call top co-equity or equity in the parent company. And this is an important distinction. A joint venture is an ownership stake in your individual hospital, and the top co-equity is ownership in the parent organization. So if you're being bought by Southern Vet Partners or VetCor or Western, you're a shareholder in that parent company that owns hundreds of hospitals. And so those are the elements that we're seeing more of. It's contingent notes or seller notes, it's joint ventures, it's top co-equity, and that's making up the rest of the purchase price that you're not getting at closing.
In that kind of thought process, Rich, how do you think about talking with your clients about top co-equity versus joint venture equity, opportunity for upside versus, kind of more concentration in an asset, kind of in a minority held company? And I know you have probably some very personal opinions on it because you built a company that was focused on kind of that joint venture, higher upside, maybe a little bit more concentrated risk. But I mean, I think we're also just dealing with a lot more volatile doctor market, maybe than when you were talking about that with, some of, your VPP partners.
Yep. So really good question. And the simple answer, I try to always simplify decision processes. And so the simple question I ask sellers is, do you want to bet on yourself and your team, or do you want to bet on your buyer? Because if you have a lot of confidence in your hospital and your hospital team, the joint venture is going to be something that you have a fair amount of control over. And when you take top co-equity, especially in a consolidator with 100, 200, 400 locations, you're betting on that management team. You're no longer betting on yourself. And there's nothing wrong with betting on that management team. It's just it's a very clear way to give a seller something to think about and how to frame the decision making. And by the way, there are 64-year-old sellers who are like, I'm worn out. I just want to be an associate. I'll take the top co-equity. And there are 54-year-old sellers who much more often will say, I want to bet on myself. Like I've always bet on myself and it's gone well. And so you get different answers, and there's no right or wrong answer. It's a very personal decision about how they view themselves going forward, and also how they view the people that they're selling to.
Well, there's also too, and I think like this is where folks like yourselves can come in, is not all top co equity is the same. There's that's where we've had to come in a lot. And if there's not somebody that's representing them and help them to understand, like, just because it's a parent company equity, they're not all created equal. I mean, there's a huge dispersion with not only track record, but also just current financial strength of the company. So, I mean, is that something that you also provide advice on?
Yeah, and we ask a lot of questions of the buyers to understand, like, there's a value, the buyer is placing a valuation on the seller's business, but every month or every quarter, the buyer is doing an internal self-valuation because they have to issue shares at a certain price or units. And what multiple of EBITDA are they using to value their own equity that they're giving to you? How are they calculating that EBITDA? What are the add backs? What are they doing and not doing? There's a lot of questions to be asked. And I can assure you that some of these corporate groups are valuing their equity very aggressively still, even though the market has settled down, and others are valuing it much more conservatively. And the returns that you get as a seller on that top co-equity, it matters what your entry point is. If you're taking equity from someone who's valuing their top co at 18 times EBITDA, you have a much better chance of upside than if the other bidder is valuing it at 21 times EBITDA.
Well, and whether or not they even have EBITDA, it's just based on top line or whatever.
They always have EBITDA. It's a matter of how much or interest are they paying.
Yeah, there you go.
They almost always have EBITDA. It's how much interest, how leveraged are they? There's lots of different issues around that. And one of the things I mentioned earlier in passing was, in 2021, there were 5 groups that bought 50 plus hospitals, and none of those folks are buying that aggressively today. And part of that reason is they're trying to figure out how to run and operate all those clinics that they bought in 20 and 21 and into 22 efficiently. Like, some of them grew too fast and their margins and they didn't have the infrastructure to support it. And so they're focused on operating their businesses better. And that's not a bad thing, but it makes you wonder, how are they valuing their top co-equity if they do buy stuff?
Yeah.
Yeah. And I'll make one other sort of observation about the market that you and your listeners may be curious about. And so in the last 4 months, there have been, I believe, 4 CEO changes of significant consolidators. And the common theme across all 4 of those CEO changes is CEOs who were focused on driving revenue growth through acquisition have been replaced by folks who seem to have a more focused, I'm going to call it, operational background of, how do I run a multi-site business and drive profits out of a multi-site healthcare business? And so you see a change at the top as to what some of the groups are focusing on. And the growth at all cost mentality has clearly changed.
Yeah. And that's super important. 2 completely different mindsets at the organizational level, different skill sets.
Well, and you raised another kind of question there that I may kind of dive into, if you're all right, James, is like, obviously there's this move to efficiency, right? Like they've got to, we kind of, at the end of the day, I think some of the low hanging fruit going after, some of the distribution, cost of goods sold, like some of those things have already been captured in all of these models, right? Yeah. And then as these organizations have grown, they've had to layer in management to run the companies run the individual businesses because, they're not highly concentrated, and none of that was in place before because they were always patriarch led. Rich, how do you see kind of this like consolidators happening and playing out, and most importantly, impacting individual hospital owners as this kind of drive for efficiency it becomes really critical to investors in generating the returns they need.
Yep. So I'm going to make a couple of observations on this. So first, on generating sort of higher margins at the hospitals. So, Travis, you said that like the low-hanging fruit of like working on cost of goods sold has been, vendor contracting is a big advantage of size. But the flip side of that is, other than Banfield, I would argue none of the consolidators have made the really hard decisions on the cost of goods sold side. So everyone wants to be doctor friendly and say, you can order whatever product you want. So everyone has contracts with Zoetis, Elanco, BI, all the major players. The way Banfield drives their costs really low is that product by product, they make decisions on what a hospital is going to be used, what is being used. And so for a major consolidator to really drive cost of goods, they might do an exclusive with Simparica and Zoetis, or they might do a exclusive with HeartGuard, NextGuard with BI. Then they'll get real pricing leverage, but they might piss off their doctors. Is that going to happen down the road? Who knows? But it may or may not. But it's, if you're 200 locations versus 500 locations, you're not getting that much better pricing unless you're narrowing the field of options for your doctors, which hasn't happened that much yet. So that's sort of one piece. And then I'm going to make one other observation on the cost management side, which is that this industry is very different than a lot of human healthcare. And when I said operating executives are coming over from my very old company, which was DaVita, which is a big dialysis provider, people are coming over from dental, from outpatient surgery. The complexity of running a veterinary hospital operationally is much more complex in some ways than human healthcare businesses that it gets compared to. When you're at a dialysis business, every clinic that you have, what you're delivering and how you're delivering it is very, very similar in terms of patients coming in, being hooked up to a machine and going home. In a veterinary clinic, the range of services that are being offered, visits, procedures, surgeries, it's really a wide array of activities. And at each hospital, it's set up differently physically, et cetera. So creating operational efficiency on a scale and in a multi-site business is much harder in veterinary health than it is in a lot of the human healthcare fields where executives are coming over from. So that's like, there's a long way to go in trying to figure out, in my view, how to create operational efficiencies across the clinics. And then I think the other question that you guys asked was sort of consolidator of the consolidators. When does that happen? And my view, there's been a little bit of that has happened to date, but not a lot. So Vetcore and People's Pets and Vets merged, and Rare Breed and Vets Best Friends merged, and NVA bought up a couple of specialty hospitals. I don't think you're going to see a lot more of it until you have some publicly traded companies, especially with interest rates so high. And the reason for that is you can go out and buy 50 individual hospitals at 12 times or 10 to 12 times EBITDA. Why would you pay 17 or 18 times EBITDA to acquire 150 hospitals from one consolidator? Like, it doesn't necessarily pencil out from a return on investment standpoint. When it does pencil out is when you're a publicly traded company and you have easy access to equity capital through the public markets, then making those types of bigger moves makes sense. And if you go to other segments of human healthcare, when you see companies going public is when the consolidation of the consolidators really starts to happen. So I think 26, 27, a year after some of these companies start going public is when you start seeing more consolidation of the consolidators.
No, that makes sense.
So
And on the kind of public market space, do you see some of these larger consolidators, use NVA as an example, right? Pulling a page out of VCA's book and starting to dive into some other pet care businesses and trying to surround themselves with other pet care businesses over the next 18 months before they go public?
It's a very good question. I used to work with the former head of NVA, and over the last 8 years, when I've talked to him on and off, I was always like, why don't you have a lab? Like, why don't you build your own lab? And it's not as simple as you think. And, to own and run a lab, and you've got two very entrenched competitors in there doing it, with Zoetis trying to be a third. And so I think that ancillary businesses do make sense over time. I think right now NVA is more focused on, like, they're splitting their specialty and general practice business into two different businesses, and they're going to try to take each one of those public. So I think that once they are public, they will probably start looking at that stuff. But I think they have enough on their plate trying to divide up into two separate businesses before they start looking at, do they want to get in, VCA over time ended up private labeling some flea tick heartworm medicine that they sold exclusively through their clinics. And they obviously always owned Antech. And so I think you'll start to see that, but I think it's going to be down the road some. I don't think it's in the near term.
No, it's always a fun conversation, right? And getting everybody's observations. And I mean, we're all just kind of prognosticating and kind of, it's an unknown space, I think.
I got one a little bit more for you, Rich, too. I know we're trying to keep this to, within a lot of time here, but I did have a couple things on that I would hope for you to just quickly touch on before we pass it over to Travis. We can wrap with our classic final question here. But I think it's really relevant to where the hospital owners' heads are. So one is, if you can just touch on the probability of LOIs being closed in the current market. And then once you've touched on that, if you can speak a little bit about inflation, what you think the trajectory is going forward on inflation and interest rates, just real quick to wrap us up there.
So what was the first question?
So when a client goes under LOI, how are you helping them understand the probability of that actually closing? And does it vary by buyer to buyer?
Yeah. So probability of closing in 2021 was probably 95 to 98%. Today, it's probably 80 to 85%. I would say the probability of closing is higher with a broker than without one, just because we can see things and help negotiate things. And I think, the key is don't lose any doctors. Make sure your doctors are stable when you get in, once you sign that LOI, because the biggest reason LOIs don't close are either doctors leave or there's a fall off in profitability for some other reason. So that's one. And then the second question you had, I'm sorry.
Yeah, I was just seeing if you could touch on
inflation.
Yeah, inflation and interest rates. I mean, obviously that relates to a multitude of things inside of a practice.
Yeah, I mean, I think the biggest comment is that the U.S. economy has proven to be really resilient. I mean, interest rates have gone through the roof to highest levels since the 80s, and yet the economy still seems pretty good. So I don't expect interest rates to start falling until middle of next year at the earliest, like probably a year from now. The economy has been growing at a reasonable pace. Interest rates are high. They've brought inflation down. I think by early next year, you'll see inflation under 3%, but I don't think you'll get it to 2% for a while. And so I think rates stay relatively high for at least the next 9 months. And I think inflation will, in the next 6 months, inflation will bounce between 3 and 4% just because of what happened last year. And I think by early next year, inflation will start going under 3. but it'll be 2.5 to 3, not sort of closer to 2, which is what the Fed says they're looking for. So the economy's been better than we thought, is basically my overriding observation.
Yeah, I love it. Travis, why don't you take us out with your final question?
Yeah, well, Rich, we kind of always wrap this up with one final question, and I don't know if you've listened at all before. You've probably heard us ask this. There's a quote that hangs in one of my friend's bathrooms that says everybody wants to change the world, but no one wants to change the toilet paper. So we kind of ask each one of our guests, have you ever snuck out of the bathroom without changing the toilet paper, Rich?
In my house, I usually am the one to change the toilet paper. Somewhere else, I definitely leave it alone.
That's fair enough. That's fair enough. Well, along that same line, we always like to wrap up. If someone does want to change the world, what's the one piece of advice that you would give them?
Look, if you want to change the world, you've got to think big. You've got to have a big vision, and you've got to have confidence to go after it. And the world is hard to change, I always say, but changing your little corner of it and impacting a bunch of lives is very, very doable for a lot of people. And hopefully throughout my career, I've been able to help people and change and improve a number of people's lives. I haven't changed the world, but I'm always trying to help and change some things and have an impact.
Awesome. That's beautiful. Well, we love that, Rich. Thank you so much. Again, this has been the Vet Worthwhile podcast. We've had Rich Lester, co-CEO of the Ackerman Group. Rich, how do people contact you if they heard something that they thought was interesting or had a follow-up question? What's the best way for them to get in contact with the Ackerman Group?
Yep. So my cell phone, which I shouldn't give out.
Oh, boy.
207-450-8800. And then my email is rlester, RLESTER, at Ackerman-group.com. And our website is ackermangroup.com, ackerman-group.com. So lots of different ways to get us and see our content, and happy to talk to anyone who heard something today that they want to dig in more details on.
Awesome. Beautiful. Well, thanks again,
gentlemen.
Rich. Travis, good to see you. We'll see you all next time. Thank you.
Thanks.
Thanks again for tuning in to the Vet Worthwhile podcast. You can find us online at signaturefd.com/signatureveterinary. And then our ask would be, if you found this episode valuable, just think of one friend or colleague that you think would enjoy the content, and just please share. So thanks again. We'll see you next time.
Travis York is the owner of 3-in-1 Vet Advisors and a partner of SignatureFD. 3-in-1 Vet Advisors is a veterinary consulting and strategic planning firm of which SignatureFD has no involvement or ownership. James Yost is a partner and wealth advisor at SignatureFD. SignatureFD is an investment advisor registered with the U.S. Securities and Exchange Commission. 3-in-1 Vet Advisors and SignatureFD are not affiliated. Mr. York provides all non-investment advisory services through 3-in-1 Vet Advisors. The opinions of the guests and the contents of this podcast are intended to be educational only and should not be relied upon as investment, tax, business, or planning advice. You should consult with a professional advisor prior to taking any course of action that may impact you or your business.